The next step we are really excited about this because this is our first model leveraging machine learning and artificial intelligence. So it's the first step towards a quantitative approach, right? And this is also something that has been asked for us from our users, which is a swing trading model, right? So the model is designed for traders who have a longer term horizon, that are not in front of the screen every day and that are interested in swing trading and not the day trading, right? So if you just want to trade with a 20 days horizon, 5 days horizon, now we have a model that can help you there. So the model uses as an input our net delta and net gamma, as well as momentum, price triggers, and other proprietary option signals to get 3 levels on your chart. The model offers first a directional bias as well as a volatility component that allows us to forecast potential price swings of an asset over the next few days and weeks. So we have 2 time horizons that we offer within the model. One is the 5-day and then is the 20-day. You'll be able to access this model directly to the bot in the morning on the asset. Again, right now we don't cover futures, but we will in the future, but we cover all the stocks, ETFs, and indices. But let's break down on how it works. So the indicator has 3 components. One is the upper band. So the upper band represents the highest price level that the model predicts within the specified time horizon, whether it's 5 days or 20 days. And what it does, it helps traders identify potential resistance level and look for upper limits of the price movement. Then we have a second level, which is the lower band. And the lower band indicates the lowest price level forecasted by the model within the time horizon, which is 5 or 20 days. So it can give you really good insights of potential support level and help you identify entry and exit point. The third component is the risk trigger level. So the risk trigger is a very important component that alerts trader when the price approaches level that could signal significant market movements. It could be signaling a new trend, it could be signaling a trend reversal, and so on. So it can help you really understand when the volatility is changing and maybe what to do with your trade and how to plan your trade accordingly. At the top of the chart, and I'm going to make it bigger, you can see the backtesting results of the model on the stock that you're looking at. So if you are requesting Tesla or Nvidia, it will show you the success rate of the upper band, the lower band, and the risk trigger. And also, it will show you the success of the model as well. For success rate, what does success rate mean for us, right? For us, it means that if the price of the asset in the next 5 or 20 days close above the lower band or below the upper band. And we're going to explain this in a few seconds. So this brings us to how can you use the model? So on the right-hand side, every day, the model will show you 2 price levels. We're going to have either an upper band or a lower band. We will never have them on the same day. And these lines are the ones that are considered by the model and have a higher relevance. Then you can see the risk trigger level. That could be either at the top if the lower band is present or at the bottom if the upper band is present. So the dotted line is really a risk assessment level. Those 2 levels express the volatility range of the asset within the specified time horizon, so 5 days and 20 days. And these levels update on a daily basis. So let's go to the next slide. This brings us to our directional bias. So if an upper band is present, our model based on the data has a bearish bias. That doesn't mean that the price is going to drop, but there is a bearish bias and there could be a bearish trend. If the lower band is present, then our model based on the data has a bullish bias. So again, how can you then use the model, right? So first, swing traders. So this model is designed for swing traders. Upper and lower band can define your trading roadmap. So when you're swing trading to the upside or downside, they can be your target levels or your stop loss levels. So very important. If the price approaches the upper or lower band, it could be a signal of a potential reversal. Again, very important information. If the price breaks above the risk trigger level, it could be a sign of an increased volatility. So it could be a start of a new trend, for example. Who else can use this model? Stock and option traders. So these levels can be used by option traders to place their strikes. direction, exit plan. If you're a directional trader and you're long or short the asset, you can use this level as potential profit targets, stop loss level. But finally, option sellers. This is a very important tool for option sellers, because if you're looking to sell option and you're looking for premium, the model has a larger time horizon, right? So a lot of our users are zero DTE traders, but that obviously can be very dangerous because you're not getting a lot of premium for the time that you're in the position, right? So now we have 5 and 20 days, and that allows you to take a larger premium by limiting also the risk. And after this session at 12:30, we're going to be live with Doc, and we're going to go over option selling strategies and how to use this model for swing trading.